With trillions of dollars of businesses that need to transfer hands, private equity as an industry is coming up from behind as the dark horse of high finance. Join me in this second installment of our private equity mini-series with my dear friend Adam Coffey as we take you on the final stretch on closing deals, raising capital, and exiting for billions. All this and more coming right now. Here we go. Hey, welcome to another episode of Making Billions. I'm your host, Ryan Miller, and today we are covering the second installment of our two-part mini-series on private equity from the legendary Adam Coffey himself. As mentioned in the first episode, Adam is a three-time best-selling author of Empire Builders, the Exit Strategy Playbook, and the Private Equity Playbook. He's a frequent contributor to Forbes and has sold over, get a load of this, $2.5 billion in private companies. He's recently updated and expanded his edition of the Private Equity Playbook that further outlines the strategies that work in today's market. So what does this mean? Well, this means that Adam understands how to buy companies for no money and sell them for insane profit. So Adam, welcome back to the show, brother.
Ryan, it's good to see you. It feels like, I don't know, like we haven't done this in a long, long time. Like maybe a few days ago or however long ago it's been. It's like, it's good to see you, brother.
Yeah, it's always good to see you, man. Every time we talk, I feel like I get a little bit smarter every time. So,
hey, me too. Not a day or two goes by where people don't reach out. Hey, I saw you on Ryan's podcast. I'm like, you know what? It's like there's something magical, about you, about making billions. I mean, I think that just that brings them in by the truckloads right there.
Thank you for that. We've been fortunate to be in the top 2%, and honestly, brother, I couldn't thank you enough for being part of that.
Yeah, I think we need to see you like on a TV, version of this. I don't know. Producers have been reaching out to me. I'm going to send them to you. I'm going to be like, you need to get this guy on TV.
All right, man. I smell something brewing together here. So that'll be fun. So for all of us who are just tuning in, I'd love to recap so far what we've covered. So in the first part, we covered how to begin and get your heading, get that locked in, how to know if you have a good idea or a good deal sitting on your desk, telling the story with numbers. You and I both understand that. And many people listening to the show, building a plan with no money and how to prepare for the hunt. So today on the second part that we're going to do for you guys today is we're going to cover contacting your potential sellers without scaring them away. Yes, you could do it. There's an art to this. Tips on just fulfilling your due diligence and really making sure that you understand what you're doing. You're doing it with your eyes wide open. How to get all the funding you're going to need to buy these companies, right? You can have the best idea, but if you can't get the capital, we've got problems. So we're going to cover a lot of that, how to close and run those companies that you just bought, and then finally how to plan for the almighty exit. So I'm excited to jump into that. So when reaching out to your prospect, maybe you can help us understand when you're contacting your seller, where do you go from this point?
So I think we ended the last episode by talking about, building our list, how are we going to prospect? And we had some tools that we talked about that we could use. And a lot of those tools just kind of depended on price point. If we have money, we can accelerate the time. If we don't have money, then we have to invest the time. But when we find these people, I think my first advice, Ryan, is just simply that, look, when we're buying a company, this is a person-to-person transaction. This is done at the human level. We might be looking at numbers and talking about multiples of this or multiples of that, but we're establishing, a connection with a person. This is their baby. This is something that they've spent a long time building, and they're emotionally connected to that. And I say jokingly, it's like we don't walk up to our future spouse and in the first 30 seconds, ask them to marry us. I mean, there's a courting process. There's a dating process. And when we're thinking about buying a company, I get my best deals when I reach out to people that don't yet know they're a seller when I first meet them. And so that means they haven't mentally prepared to sell. They haven't hired a broker. They haven't decided to list it on LoopNet or someplace. And so it's like they're not focused in a seller's mindset. And so I'm doing cold outreach, and I find that I get my best deals when I do that. Certainly I will buy some from, that are listed by brokers, but again, it's like when we're hunting, we can't just rely on brokers. We can't just rely on listings on a website, too much competition, too many people focused on just price. I don't want to be the highest price bidder. I want to buy a great company built by a great entrepreneur, and I want to pay fair market value, nothing more, and be very disciplined in the process. So when we think about starting this outreach, if we're doing it ourselves, that says either we're just good, it's one of our skills and we enjoy doing it, or I don't have the money to hire a buy-side advisor, get someone else to do it for me, then, a typical buy-side advisor would tell me, hey, Adam, I have to do outreach 6 to 8 times potentially to elicit some kind of a response. And buy-side advisors are so good at this. They generally will get 80 to 90% response rate eventually, even if it's just the entrepreneur saying, hey, quit bugging me. It's like, get away from me. I'm not interested in selling, but they're going to get some type of a response. And so when we're doing outreach, I go back to thinking about my avatar, my buy box, who's that customer? How am I going to reach out to them? What are I'm going to make some kind of a brochure, some kind of a little pitch deck. Older people, I might be doing snail mail, like actually mailing it. I might have someone with a much better cursive writing than mine, actually handwrite out the envelopes, because when an entrepreneur, or a person receives something, if it's got stickers on it or barcodes or reduced mail, it's like, for me, that thing never gets opened. It's just ripped up, thrown out right away. But when it's handwritten, it's got stamps on it. I'm like, look, I don't know what the heck this is. Curiosity killed the cat. I got to open it. And so we're doing outreach potentially via email, via snail mail. We may be calling people on the phone, but what we're trying to do, and I don't know about you, but certainly in my world, I don't answer a phone if a random number just pops up. I just let it go to voicemail. I only answer people that I know, at too many sales calls that are out there. So I might have to have a little script, but what I'm trying to do is follow some kind of a pre-programmed, not necessarily script, but just goals and objectives. My goal number one, if I can get somebody on a phone, I'm probably going to reiterate what I just sent them. Hey, listen, my name's Adam Coffey. You don't know me, but I've been buying and selling companies for decades, and I am focused right now on this particular industry. And I've been looking at companies, and I came across yours, and I'm so excited. I love what I see. And I'm wondering, have you ever thought about potentially doing something special in the industry? That could be selling the business, growing it, buying other companies, putting together with it. I'm on the hunt. I came across you and I like what I see. And all I'm trying to do, my goal and objective with my first conversation, is kind of break the ice, get to know them a little bit, let them see, a little bit about who I am, the background that I've got, the dirt that I've chewed. But my only real goal, I'm seeking to set up a lunch. I'm not asking them, what's the price? I'm paying 5 times this or that. It's like, hey, I'm looking, to buy companies in this industry, in this space. I came across yours and it looks fabulous. I was poking around on your website, and really like what I see, fits right with my goals and objectives. Wondering if you were ever, curious about doing something special, and if this resonates, with you, can I come down and see it? Can I buy you lunch? Can I, depending on where they're at. And I use this strategy all the time. What's my goal? My first outreach, I want to continue the conversation, break the ice. But what I really want to do is get them to lunch. What do I do when I get them to lunch? My only goal and objective from that lunch, I might schedule 90 minutes to 2 hours in person. And, frankly, my only goal is to just kind of lay out, in a very brief little fashion, probably towards the end, we've probably been chit-chatting. Hey, I found out in the first call that the guy plays pickleball. He's an aspiring pickleball, grand champion in the making here. It's like, it was telling me about a tournament, hey, it's like, how'd that tournament go? Whatever. It's like, there's a lot of chit-chat. We're talking about family. We're talking about everything except selling the business. Somewhere as that conversation kind of is morphing around, I might throw out there, hey, listen, thank you so much for meeting me. Want to hear your story, want to hear how you got here, how how this thing kind of unfolded, get them talking about the business. I'm learning things, as they're talking. I can throw out some questions that can help steer the conversation a little bit. But my real only goal and objective is to just kind of lay out, hey, listen, let me just explain how my process works. Happy to sign an NDA, something, non-disclosure agreement, protect your information. Happy to do that. If you don't have one, I'm happy to offer one. And really what I'm looking for is just some basic information about your business, and I'll kind of lay out a framework. Hey, look, I'm looking for 2 to 3 years worth of financial statements, balance sheets, If the business is doing accrual accounting, then it's like statements of cash flow, looking for basic financial information. I've got some basic questions just about your customer base, who you serve, and some basic, questions that I might have depending on the industry, and I'm going to give this to you. And, if you're comfortable when you share that information back with me, if I've got any questions, we'll set up a call to talk about it. But, other than that, my goal and objective is take a look at the numbers and come back to you and give you a number and let you know what I'm thinking in terms of valuation. And if you like that number, hey, we keep talking. And if you don't, that's okay. Let's stay in touch. My number might change. Your number might change, but this is kind of how it works. So goal first call, get to a meeting in person. Why do I want to be in person? Because this is a personal sale. This is a connection. I need to build a relationship with this person. We can't just rely on Zoom. I'm happy to have a phone call. I'm happy to do Zoom up front, but somewhere we got to get in front of them. So first call, I just want to get in front, of them. And when I'm in front of them, all I'm looking to do is just get an NDA in place, get an information flow, starting to happen. If I have clarifying questions, I'll ask them, once I get some data. I take everything they give me at face value and assume it's accurate at this stage. And so I'll take based on their numbers, based on what they share, got a few questions answered, know a little bit more about, is this the kind of company I'm interested in? Remember, we had that buy box, we described the kind of perfect acquisition we're looking for. Does this fit? If it does, I'm liking what I'm seeing, it meets my basic rules, I'll bring them a number, and I don't bring in a lie. I just bring a number. And I don't need to do that meeting in person. Phone, Zoom, first meeting, in person, second. Want to set up a meeting, want to get an NDA. I've got the information because we've been in front of each other now. We've got a rapport that's been built up, and I don't just go right to business. We talk small talk. Hey, tell me about your family. Tell me about what's going on in your world, stuff like that. And so now I'm bringing in a number, and I might talk to them loosely about structure. Again, I have to remember, in my case, in my situation today, I'm passive. I'm not looking to step into the business. People listening out there, they may be looking to step into the business, as the CEO. They're going to be the person doing the buy and build. In my case, I'm passive. I'm going to provide governance. I'm going to be looking to build an empire. I'm looking to go buy other companies in the industry. Right now, what I'm looking for is I'm looking for my platform. I'm looking for an entrepreneur that I can back, somebody that I can work with, partner with. You'll share in the growth. You'll share in the financial upside that we create together. And so I'm bringing them that number. If that number is exciting to them, my next step then is going to be I'm going to bring them, a letter of intent. When I say bring them now, at this point, I'm still sending it. One in person, I'm going to send them now. Call it the letter of intent. I'm not going to download a form off the internet, and say, I found this on Google. Here's my letter of intent. Nope, I'm going to engage my counsel right now at this stage. Letters of intent are non-binding, but I want to be able to lay out kind of some of the salient deal points that I'm looking for. If I think something's controversial, I might punt it until you up to the contracts and stay silent on a specific provision. But I'll want to kind of flush out. Here's the value. Value's kind of based on a certain set of numbers that were given to me. Here's the earnings, that I'm seeing, et cetera. And so, like my number, letter of intent comes next. Lawyer engaged. My first legal cab meter just ran for a little while. Not too bad. And so I get that in front. If we get it signed, then we're off and running into diligence. But just to stay on this topic for a little bit, I'm kind of doing this on the fly, which is, it's like, this needs to be a natural conversation between two human beings. We don't write down and read a script. When we are reading, how we write English, I'm an author, I can talk about this stuff. How we write is different than how we speak. And so the voice, when we write bullets and say, if we try to write a script, it comes off sounding fake and foreign. And we don't want to be scripted like that. I have a goal and objective. I'm breaking the ice. I'm getting to know this person. I'm going to be learning without asking too many questions that feel intrusive or direct. And so I'm a sponge. I'm having a conversation. I'm learning about things. We're building that relationship. And let me just say, on numbers, I'm a disciplined buyer. And so if I'm expecting to pay 5 times, because that's what my research says a company of this size is worth, and they're looking for 8 times, we're too far apart. This probably isn't going to work, and so I'll want to kind of part ways, because again, I may have identified 1,000 companies that are loaded up in my funnel at the top, and I do an outreach to 100, 150 that I think are kind of priority one targets, and I'm having multiple conversations with people, and it's a numbers game, and not everyone's going to be yes, and not everyone should be yes, and we need to be really disciplined. I'd rather not buy a company I should have rather than buy one I should not have. Something to keep in mind. And so, it's a numbers game. You would be surprised, Ray, how many people that on that initial offer, we kind of part ways, how many actually come back, and they might have a brochure that I did from the cold outreach. They have my number in their mind. It's sitting in their inbox. They're 65 years old. And you know what? They had a bad day. Customer pissed them off and giving them a mouthful. Maybe they didn't feel good. There was a health scare. Something happens, and they just I'm getting tired. Maybe I ought to call Adam. Maybe that number's right. And so maybe they've gotten 2 or 3 other calls. Maybe other people give them a number. And the number's not much different than mine. And so they're motivated now, starting to think about selling a little bit more actively. I'm the ace in the hole. And 6 months after I parted ways, somebody calls me out of the blue. I got a deal going just like that right now. Someone we met with 6 months ago, and the numbers originally didn't work, but we stayed in touch, reached out once in a while, said hello. And now, deal is signed, LOI is signed. We're at Diligence. I expect to get this thing to the closing table soon. And, this is a person that started with cold outreach, and they weren't a seller. We built a relationship over time. We did these basic steps, and had the call. I invited them to lunch because they're local here. And so I brought them to my home court. I live in a nice country club. And so brought them here, built that relationship. And now the numbers work, and we're doing the deal. So we have to be patient. We have to always be kind. We have to always be genuine and be nice. Because as I said, when the numbers are far apart, eventually these deals can come back, and our number might change. If I find the perfect platform, maybe I'm later stages. I'm smelling a 15 multiple on my exit. And so maybe, when I was buying at 5, I'll stretch for 7 for this guy because I really like them, like this company. And it's going to help me bulk up right before I'm going to market. So I'll pay a few extra turns because I know I'm going to sell for 15, and I got plenty in at 5. And so what the heck, I'll do one at 7.
So here we are. We're in the moment of deal verbal, right? We're just saying, how is this going to work? You're in this dance in the beginning. I've done it. You've definitely done it as well. This is a very crucial time. So first of all, for those of you who are listening and you followed it so far, congratulations. Wow, you're actually talking to an entrepreneur or an owner about selling to you. This is huge. You've made it this far. But we are not done. This is the part where people can freak out. Either they're freaking out because they have some idea that came out of left field. I mean, they just have deal anxiety and they're starting to see that this is actually happening. Or it's something that maybe you said like, hey, I'm going to buy your company and I know your name's on the building, but I'm going to change the brand and do all these other things. And you start, even though you want to come in and you show, hey, I got a plan, I'm going to do this, and you might freak them out. And so I'm just curious from your perspective, this is the point of, we'll say, one of those points of peak anxiety. Talk about some of the things that you definitely don't do. Maybe one or 2 things that you definitely don't do at this point.
Yeah, you just touched on, I think, one of the biggest ones. Let's talk about branding for a minute. Now, I'm a guy who's built 3 large companies, and I rebranded all 3. Branding is, I think, probably the most sensitive issue for a seller. And it's one that we need to tread lightly on, because you will kill a deal and blow up a relationship that you've been building if you come out of the gates with, well, your name sucks and I'm going to change it. And of course, we would never say it in that fashion, but even if I said it in the most pleasant tone, in the best of ways, that is a potential deal killer. It's like, hey, that's my dad's name, that's on that building. And dad passed away last year, and it means something to me, and it means something to our customers, and our customers value that name. Well, I might think differently that, my experience has been names aren't what drive, the business. Unless you're Coca-Cola, and we want to talk about major branding, in a consumer driven market, but B2B service company, they don't care what the hell your name is. They really don't. But the owner does. And so we don't want to raise that as a bone of contention. So what I have found over the years that works wonders is I talk about my brand. If it's brought up, I don't ever bring it up. But if they bring up branding, hey, talk to me about branding. How would branding work? Then I launch right into it. And what I have found that diffuses this potential bomb that could blow up, an early conversation that could lead to a deal. I lay on the look. I'm using what's called as an endorser brand strategy. The company that you've built, the company that your dad built, that granddad built, whomever it is, mom built, whatever the story is, it's like you have brand equity. And over the years, you have a customer base that's loyal, that knows you by that name. The golden rule of mergers and acquisitions is don't do any harm. I'm paying, a fair market value for this beautiful business that you built. The last thing I want to do is destroy, that brand equity that you built up. So I use what's known as an endorser brand strategy. So I just created, I'll give you an example. I just created a company, and my brand of the parent is called CoolSys. This is my old HVAC company, my refrigeration service company. And so you're Sam's refrigeration service company. And the way it works is that name stays on the truck. It's Sam's refrigeration and HVAC service, a CoolSys company. So we co-brand with the parent brand. That's the endorsing. It's called the endorser brand strategy. Your name stays on the truck. Your name continues to be marketed. We simply add the name CoolSys underneath. This unifies all of the companies that we're buying over time. And in my last run, I bought 23 companies and put them together. And so this is the strategy we adopted. All 23 names of the companies that we bought continued to exist, and we co-branded them a CoolSys company. That's called the endorser brand strategy. I have yet to find any entrepreneur that when I explain this strategy, your name stays, my endorser brand goes underneath. I found no objections whatsoever. Everybody's very comfortable with that. Now, I already told you, I rebranded all 3 companies, that I built and run. What I like to do is I don't want to make this a bone of contention early because it can kill the deal. So what I do is, I in my head, I got 10 years, to kind of flip the brands. At some point, the idea is all of these endorsed brands eventually flip. They become a part of your history section on your website where you pay homage to dad and grandma and the dog or whoever, the name of the company came from, and you tell their story. But I let them lead that charge. So, recently, in that last buy bill that I did, we had bought a bunch of companies in a region. And there was brand confusion now in the marketplace because there's all these different names and they're all owned by us. And so it's like trucks are going by like, oh, well, the supply houses are getting confused because we're all part of this bigger company. And the entrepreneurs eventually come to me and say, hey, Adam, let's flip. Let's just be known as CoolSys this or CoolSys that, like light commercial or, commercial industrial or energy, services or whatever. It's like, and it's like, they take care of it for me. What was a very contentious potential conversation early, a few years down the road, becomes something that they support, illogically. So I let the brand part move at its own pace because I truly have found that is one area where, they're attached to their name, whether they should be or not, it's irrelevant. They are. And so we need to be very careful treading around that. Other than that, there's not a lot that I have found in decades of doing this that is just so sensitive. There are a couple things that'll pop up later in diligence. One of them is stock versus asset sale. That'll usually rear its head. And then somewhere later on down the road comes the second guessing. Should I, as you said, I'm actually doing this. I spent years building a company. I'm getting ready to sell it. It's like, should I do this? I start getting seller's remorse. I get cold feet, and so there are some other places where I see some objections, but generally at the LOI stage, there may be some kind of conversation around, rollover investing and why would an entrepreneur want to continue to have financial stake in the game. Part of this is driven by a strategy. So let me just put out on the table. Throughout diligence, throughout the process of buying and getting to know these people, what I'm doing is I'm assessing risk. What is my risk? I'm paying a multiple of earnings to buy a company. What is the risk that that revenue could disappear if the founder disappears? If I have bulletproof contracts, long-term, can't be canceled, don't have to worry about it. Okay, entrepreneur can sail off into the sunset. I could potentially not make them a rollover investor. I could potentially just have them on a consulting agreement for a year and then let them bug out. Help you with some transition stuff, and then you can be on your way. But if I assess that there's a risk of losing the revenue, a risk of losing, the multiple of what I'm buying, then I need to somehow put some handcuffs on that entrepreneur to help them align with me to make sure that we're both motivated to want to integrate, and keep that risk at an absolute minimum. Generally, I do that through rollover investing. So one of my empires I bought 34 companies. Only one entrepreneur stayed out of 34. The rest of them just got a consulting agreement for a year and they were gone. I kept one because it was a strategic pivot. It started a new division and I needed someone to run that division. And that's why I bought his company, was to give me that expertise. And they became the president of that division. The rest of them sailed away because there was no risk to me losing the revenue that I was buying. At my last company, tremendous amount of risk. Although I had service contracts with the client base, industrial service contracts generally have a 30-day cancellation provision, either party. So that's a ton of risk. I can't afford to lose everything I'm buying, because I'm still going to have to pay for it, even if the customers walk away. But if I can literally lose the entire revenue stream in 30 days, that entrepreneur is not getting my money without me somehow getting them as a partial owner of that risk with me. I could do that with an earnout, take a portion of the purchase and say, based on retention, you earn additional consideration a little bit later on. I could do that with contract language, different ways to do it. I like to do it with rollover. I need you to stay. You can, if you're 70 and you want to dial out, if we've got a number two, I'll usually talk to the owners and I'll say, you got to at least give me a 1-year notice before you leave so that together we can mitigate the risk. We can make sure that we've got either your number two running the show, or I've got someone from the rest of the empire who's moved in and is ready to take over, the show. Work with me on that transition. If you are ready to go, it's time to retire, happy to let you do that. But I'm still going to need the economic interest in rollover. So sometimes I have to talk through those kind of objections. Well, I want all my money at close. Well, there's risk here, and so because there's risk, let me talk to you about rollover investing, second bites of the apple. And let me get you excited about the prospects of getting multiple paydays. What's better than selling your company once? Simply get twice. My personal record, 5 paydays in 13 years, same company. Let me talk to you about that. Let me show you how that works. And so I can overcome that objection. It's not as much of an objection as the brand, the brand and potential name changes. So there are things that could pop up, throughout, but pre-LOI, usually for me, it's primarily brand is the time bomb, that could blow up in my face. And then the rest of it is just noise with a little conversation I can walk through. Need you to stay, want you to stay, need you to be a rollover investor. But something else, Ryan, too, we're going to talk about a little bit later, is when we're figuring out how to pay for this business, rollover and how I structure the LOI, I may be thinking in advance about how I'm going to pay for this deal. And if I'm paying a multiple that requires, let's say I have to pay 7 times for a company, but I can only lever 3 or 4 times. I've got a gap. I either need to write an equity check to fill that gap, or I have to get creative on, let's do some seller financing. Let's do some seller rollover. Let me bridge that gap so that I can get down to the leverage or the amount of loan capacity that I'll have to buy that company based on the cash flow that's in it that I need to use to service, that purchase. I should be thinking about the financing, before the LOI, sizing up, how's this deal going to work? What's the price going to be? What are the things I'm going to need in the LOI in order to make sure I get it financed, as I get into diligence and get on the backside. So all of this is interrelated. We talked about models and building models, in the first episode. This is where I've already done my homework. I know what these companies are selling for, and I've already kind of figured out how I'm going to pay for them. And so that method needs to be somewhat reflected into the LOI. If I'm going to ask the seller to take on a note, and or provide some level of financing, if I'm going to need them to roll over and go for a second bite of the apple, I need to know all that up front. So as I'm breaking the ice and building the relationship, I can talk about some of these issues and weave them into our conversation.
Yeah, that's brilliant. And, when I was a young man, I was fortunate enough to hang out with Warren Buffett. He taught a lot of things, but one of the things he says, if it doesn't make sense, it doesn't make sense. And so if it doesn't make sense intuitively, it's not going to make money. And a lot of that really comes down to doing your due diligence, making sure that you research the deal, unpack this deal, really take a peek under the hood. And I know that's a big part of closing these deals. So we're at the point, you've built the relationship, you've built, we'll say, status or some mutual respect between each other. You're navigating a little bit of the cold feet at this point. But now it's time to say, okay, I've talked to you, you have a business, we agree that you're going to sell, we got to meet a few things. I need to take a peek under the hood and do my due diligence on you. You request a lot of information. Talk about the due diligence phase that comes up. Now that you're speaking, they're sending you all kinds of data. What do you look for? How do you do due diligence on these deals? Take us from there.
Yeah. So I'll say anyone who's sold a business before to private equity would say that private equity does way too much diligence. They'll spend 4 to 6 months doing diligence. They'll ask you the same question 1,000 different ways to Sunday. And it's like, and eventually you just get worn out. It's like, are you closing or not? It's like, let's get to a closing table because I'm done. It's like, I'm tired. I give up. White flags are going up. But I'll tell you, most entrepreneurs that buy companies don't do enough diligence. So I got the extreme of PE. And the reason they're doing it is fiduciary responsibility to their investors. And, and they want to make sure that they've uncovered every possible avenue of risk that could potentially exist, and that they've accounted for that in the model, in the purchase price, in the contract, et cetera. But entrepreneurs get just too lackadaisical about this. So the way that I break diligence down, I'm going to start by just saying, look, numbers, if a deal is going to fall apart, once I've got a letter of intent in place, remember, pre-LOI, I took everything at face value. Whatever you told me, whatever you gave me, I take it as being real. As soon as that LOI is signed, now I've got some period of exclusivity, generally 60 days, could be 90 days, where it's a non-binding letter of intent, but you agree not to market this to somebody else. I'm going to start spending money to verify everything and put the financing together, do everything I need to do. And so the seller is agreeing to give me exclusivity. I start with quality of earnings. Quality of earnings is a process of looking at those financial statements and now starting to tick and tie everything together. I want to check, bank deposits against transactions. It's an accounting thing. And so I can, I need to verify that everything they told me pre-close is actually real. And it's not that they lie, but right, sometimes we buy small companies from people who just don't have a sophisticated level of accounting. They're operators, they're plumbers, they're electricians or whatever, construction guys, or pest control guys, or, even bookkeeping and accounting firms, whatever that they may be. Sometimes they don't keep their books, in order, and they don't know what they don't know. I mean, a few years ago during COVID, it would be common to see, like PPP loans declared as revenue, or, ERC tax credits, as revenue. Well, it's not. It's a one-time handout, from the government. That's not revenue, and tax credits aren't earnings because they're not repeatable. And so common mistakes, books just are a mess. And so they don't know what they don't know. But we want to do a quality of financial earnings first. Why do we go there first? Because in my experience, 90+% of all deals that die post LOI die because the numbers weren't accurate. I'm paying you 5 times. You told me you have $1 million in earnings. I'm looking under the hood now, and I see that $1 million in earnings is really $350,000. And that $650,000 delta, that's a material change, because instead of paying 5 times, now you're asking me to pay 12 times to get back to the same purchase price. And so I have a framework that I use. First of all, if we don't know anything about quality of earnings, we can hire somebody that does. And if I go to an accounting firm, I'm looking for an accounting firm big enough on their website to have transaction services as one of their services. Underneath transaction services, I'm going to find, advisory services that deal with, buying companies, selling companies. And I'll usually see it just listed right there, quality of earnings. Now, when I call an accounting firm and tell them I need a quality of earnings done on an acquisition, accounting firms apply different levels of standard. And so public company quality of earnings would tick and tie literally every single bank transaction and entry on a bank statement to every transaction. It can get really, really detailed. It could cost a fortune. If I'm a small entrepreneur buying a small business, relatively small enterprise value purchase price, I'm like, okay, I don't need the public company scrutiny that costs $100,000 to look at $1 million in earnings. I'm looking for the $10,000 quality of earnings to look at $1 million of earnings. I want you to sample. I want you to use a reasonable level, but I'm not asking you to formulate an opinion or write me a letter, or apply some kind of public company standard. So I have some firms that I work with. One of them is called Barnes and Dennig. And on small transactions, I get them to do QOV for a very reasonable price. And I send my clients to these guys all the time, and I can get it done relatively inexpensively. If I do have some sophistication, in my own business, I might actually be able to have my CFO or my deal person who is a CPA who came from a transaction, services team might be able to do some of that QOV work, themselves. But I need to verify the earnings. That's number one, because 90% of deals fall apart right there. So here's my framework. If the earnings, as reported, are within 10% of what they told me, I just move forward with the deal. I don't reprice, and it's fine. It's close enough. It's going to be a rounding error down the road when I put 10 of these together, or 15, and then I'm selling it. And I've got so much multiple arbitrage that little variations aren't going to matter. But if it's between 10 and 30%, I'm going to reprice. So if you told me you had $1 million and I find 925 and close enough, I'm going to honor my price. If you tell me you got $1 million and I find that it's really 800, well, that 200,000 times the 5 multiples, $1 million of purchase price, and it's starting to get material. And so I will go back to them and I will have a reprice discussion. And I'll generally, it's like, hey, want to tell you what we found, and I'll point out where the error was between what they thought they had and what we actually find that they have. Because again, this is a consultative, friendly thing, and it's two people doing business together, and we've got a relationship now. And in my case, I'm passive. I'm going to want this person to stay. And I don't want to start my partnership with them by having bad conversations and hard negotiations. Like, I want to do this as friendly as possible. Hey, listen, here's what we found. Based on this, still love the company, still very interested in buying it, but I have to make a price adjustment because the earnings are actually a little bit different than what you showed me. So within 10%, move forward. 10 to 30%, I reprice. If it's 30%, they told me they had $1 million. And I'm finding 600,000. My repricing would be so different than the original headline letter of intent price that I don't want. I don't want to get into the argument. I just go to them. I was like, here's what I found. Here's the problem. Here's why you thought what was $1 million is actually 600,000. You can't count that. Whatever it was that you were doing. And so what I tell them, because here's what happens. Once they lay a number down on a letter of intent, in their mind, that person has already paid taxes or not paid taxes. They bought a lake house. They've got a boat. They're going fishing. It's like they got the RV in their head. What their airplane. Whatever the case is, it's like they've already allocating that purchase price to stuff. And when I come back and then tell them, hey, the purchase price is actually going to be 40% lower, they start losing stuff. Okay, airplane's gone. No more boat. RV's gone. This isn't fun anymore, Adam. Now you're pissing me off. It's like you just gamed me. You're just doing this. This is crap. So within 10%, move forward. 10 to 30, must reprice. Below 30%, I'm gonna pause the deal myself. Show them what's wrong. Tell them I still love them. Still interested in buying it. But my guess is you're gonna want to get back to work and try to fix whatever was wrong, get the earnings up a little bit more, and then reach back out to me. We'll have that conversation. I have had people come back and accept, hey, Adam, please, I get it. It's my bad. I made the mistake. Tell me what that business is worth. I still want to do the deal. So I've had it go that way, but I've also had it go the other way where people like, okay, thank you. I get it. And they go back to work. And then they reach out 6 months, a year later and say, hey, Adam, got my earnings back up now where it's supposed to be. Let's talk again. Okay, great. Let's do it. So if the deal's going to die, it's going to deal quality of earnings. Almost anything else I can contract around, and so, but a couple things. I always, if I look at diligence and all my list of 200 things I'm going to look at, finance comes first. Verify the numbers. If I get past that, I have a really, really, really high probability I'm going to a closing table. Now it's okay to start the CAB meters running on legal, but legal is where I'm going to get multiple CAB meters running, and that's where a lot of my expense is going to come in. And so I don't want to start that expense going until I know the numbers are accurate. So I start with Q of E. Once I verify the numbers, I kind of reaffirm the deal, the deal price and all the mechanics. Now I'll engage all the rest of that expense. But I'm going to look at every department in the company. You could literally just start by just list every department in the company. I got finance, I've got HR, I've got operations, and insurances and like blah, blah, blah. And literally, I have a little template that I start with that's over 200 line items. And what I'm doing during diligence is I'm looking for risk. I'm also looking at and identifying differences in the way the company I'm acquiring operates to how my company operates if I already have a company. If I have a company and I'm buying another company. Because during diligence, I'm also mapping out integration and I'm identifying all of the different things that are different about the companies. And I'm trying to identify, the priority with which I'm going to need to address them. Some things will have to be done at close. If I'm doing an asset deal on day one, I don't have any employees because I can't buy employees. I'm going to have offer letters for every employee in that company because they're now going to become employees of my new holding company where I'm putting all the assets into. And so I'm going to have to rehire all of the employees. And that has to happen on day one. If payday is on Friday and I'm closing on Monday, I better have bank accounts in place in my new company. I got to get them hired, And so we'll also have a thing called the transition services agreement in addition to a purchase agreement where I'm gonna solicit the help of the current owner. You and I are going to agree that some stuff is going to fall through the cracks and we're not going to let it. We're going to make sure the employee experience going from you to me is seamless as possible. We'll work together. If there's any cost involved, it'll get reimbursed, depending on who's making the expense and who owns the expense, and we'll work together to make sure that happens. I'm flushing all of this out during diligence. And if you don't mind, I want to talk about a couple of the common problems that we need to look at.
Sure.
Okay.
Yeah, let's hear it.
Okay. HR. This happened to me last week. A dental service organization that I'm working with is buying another dental service organization. That dental service organization has all of their dentists as 1099 employees, subcontractors. Clearly don't meet the IRS test. And what it does mean too is if I'm buying them, I'm not going to continue that bad habit. Those dentists are going to come out of my payroll as W-2 employees. I can't keep that charade going because it's not right, it's not legal, and there's penalties associated if I get caught. So their bad habit dies when they sell me the company. I'm going to make them W-2 employees. But because of that, I am now going to pay 15% on that payroll as my self-employment, call it the employer's tax, for having employees. I have to contribute. I have to do the Medicare, Medicaid, all of the taxes that go with having employees. And so I now need to go back and adjust down the earnings that they reported to me that I'm paying a multiple of. And maybe my Q of E didn't catch this. Maybe they did. I have to make sure that I'm coordinating. So Q of E may have passed, but I'm finding bad habits that I can't continue. And there was a cost impact to that bad habit. And you know what? Geez, I know because I work around DSOs all the time that dentists who are working for other dentists like to have it be 1099 so they can run a bunch of lifestyle expenses through and try to minimize their tax. And so someone says, hey, Adam, if you make them W-2 employees, you're going to lose 50% of the dentists, within the first year. Great. Well, I'm going to have recruiting costs then associated with hiring these replacement dentists. Now, I'm not going to reduce their earnings, but I might reduce my enterprise value, which is earnings times multiple equals headline price. And I might say, well, I got to hedge because I may have, at 50,000 per dentist times 5 dentists, I may have $250,000 expense in the first year, recruiting new dentists. And so as a hedge, I can contract around this. I can create a bucket of indemnification in the contract where if that happens and 5 dentists leave, I'm going to take $250,000 from a holdback, which is a part of the purchase price, which is held in escrow for a period of time post-close in case I have any expenses that we've identified in the contract that I might need to recover some of the money, some of the purchase price. So there's a lot going on here. I might look and say, geez, they have 100 employees in the field. This is a landscape maintenance company, and they have no I-9s. They don't know if these employees of theirs are U.S. citizens and legal to work. And so I can't repeat that. I'm going to have to, so I'm identified. I'm looking at the employee experience. What's their benefits look like? What do my benefits look like if I own a company? And, I don't want the first experience with me to be negative. What if their benefits are better than mine? Am I going to keep their better benefits and give all my current employees the better benefits? Am I going to make the people with better benefits go to my lesser benefits, and piss them off? It's like, oh, I'm going to find all this stuff, figure it out. I've got things then like, I've got to look at, hey, look, I got to investigate if it's a service business, all the contracts they have with customers, are they assignable if I do an asset sale? Are they not assignable and I need to do a stock sale? And so there's a lot going on in diligence. And, in this short a time frame, we can't cover all those nuances. What I want to tell you really is for the people out there, if you've never bought a company before and you've never done diligence, you need to work with somebody who this is second nature. They've been, down this road before. I bought 58 companies, and I've sold the companies I've built multiple times. It's like, we need an expert at the table with us to help educate us, guide us so that we don't make mistakes, because making mistakes in diligence could cost you millions down the road in trailing liabilities or things that you missed. And so most PE firms do extensive diligence, almost, I'd say, too much. Most founders or entrepreneurs buying other companies don't do anywhere near enough diligence. And we need that. We need to make sure we're checking the boxes, that we're making sure that we're making a safe purchase. Because if we don't, we may have stretched to buy the company and there's barely enough cash flow to cover the debt and the notes. And now we found out that after the fact, there wasn't sufficient working capital in the business. And now I got to come out of pocket with a couple $100,000 more within the first 30 days just to fund ongoing, continuing operations. And I didn't see that because I didn't do diligence. I didn't negotiate it for it. The seller took all the money out of the business. And now I got to come out of pocket and I don't have it. Now what? Do I go bankrupt? It's like, and so there's a lot to do in diligence. My checklist literally is 200 plus items. It covers every department in a company. And I use it both for diligence and to inform my thinking then about integration. It has Gantt charts tied into it. So as I find stuff, I can plan for, does it need to be done in the first 30 days, the first 60, 90 days? Can it be done 6 months down the road? So much to do in diligence. We would need 10 episodes to cover just diligence. So short answer, read about diligence. Get some coaching consultants around the table that know what they're doing if you've never done it before.
That's right. And, also legal advice, get good lawyers, good accountants, like you said, the ones that do the quality of earnings report. That's fantastic. But we're not done there. And so once you start getting the professionals involved and you bring in the armies on both sides and we're ready to do a deal and we sign and we like what we see, now the next phase is we got to get money. So sometimes when we're looking for deals, we got to pay for these things. And so debt, equity, we need to find investors sometimes. If you don't have your own capital, you got to go out and find it, whether it's credit and we want to do a levered buyout or whatever it might be. But somebody's got to transact. Somebody has to invest. And so talk about some of the intricacies that are involved in private equity when it comes time to start getting the money to close the deal.
Yeah. So if I've done my homework, if I've bought the right kind of companies and the right kind of industries with the right kind of recurrent revenue, so on and so forth that we talked about in episode 1, that in a highly fragmented industry that keeps the purchase prices low, too many companies in an industry, not enough buyers. If I've done all of my work right, then, it should be relatively easy to get the financing put in place. And so I've got different components. So let me just throw something out on the table. Let's talk about debt service coverage ratio. So I'm buying a business that's got $1 million in free cash flow. If I'm buying a great business in one of my great industries and it trades at low multiples, like maybe it trades at 4 times, and it's got $1 million in earnings. And because it's low capital expenditure, it has high free cash flow conversion. And so maybe out of that $1 million in EBITDA, 950 is actually free cash flow. So I'll just say it's $1.50 down to $1 million just for round numbers. So I paid 4 times. So I need $4 million to buy this company. How am I going to get that? Well, first thing I'm going to do is I'm going to look at what's the free cash flow. And I'm going to take 50% of the free cash flow and say, this is the amount of cash flow that I can use to service a loan. I try to build everything around a 2-to-1 debt coverage ratio. Why? Well, first of all, if I go to the SBA, I could get it down as low as 1.2-to-1, which means I have $1.20 in cash flow to service $1 of debt. But for me, that's too tight. Economy cycles south. I lose a little bit of business and all of a sudden I'm coming out of pocket and I don't want to come out of pocket. I don't want you to come out of pocket. So I go with a 2-to-1 net coverage ratio. So I got $1 million of free cash flow. I want to use no more than $500,000 to service debt. So let's take a look at this. I need $4 million. Well, if by chance I used 100% leverage, forget down payment for a second. Let's just say seller's leaving, I'm stepping in, I'm going to be the CEO. Whatever their seller discretionary earnings was going to become my seller's discretionary earnings. It's like I'm going to pay myself a salary, was already burned in the numbers. I got $1 million in free cash flow. I'm paying $4 million for the business. Buyers exiting stage left. Well, to service $4 million in debt, I'm probably going to need about $700,000. And I'm just going off the top of my head. 10% interest, $4 million. That's $400,000 a year. Probably going to need about another $300,000 for principal over a 10-year fully amortized SBA loan. And so I need $700,000. I've got $1 million in free cash flow. Well, guess what? That's not a 2-to-1 debt coverage ratio. That's too high. And so I'm not liking my deal yet. So maybe I'm going to borrow $3 million. And at $3 million, I'm going to need less than $500,000 to service that $3 million. And I've got $1 million in free cash flow with which to do it. That's my 2-to-1 debt coverage ratio. I can borrow $3 million on this deal. So I still need $1 million. Where am I going to get that $1 million? Well, if I do an SBA, and SBA will do loans up to $5.5 million. So this would fit right in the wheelhouse of SBA. Maybe I look at that and I say, Mr. and Mrs. Seller, how about you roll over 15% of the sale price into equity and you'll still own a piece of the company. You may be retiring, but I'm going to let you get a second payday when I exit your business 5-6 years down the road after I bought some more. Come along for the ride. Because it's under 19%, the SBA isn't going to make him sign a loan guarantee. At 15%, they can just ride my coattails. I have to give the SBA a personal guarantee, with the lender. And so they do 15%. So on that $4 million, I now have $600,000 in seller financing. Call it free seller financing. Their equity just became my equity. They're now a minority shareholder in the business. They used to be a majority shareholder in. So I got $3 million I can service with my own cash. I now have $600,000, of equity coming from the seller, which they'll get a second payday down the road. They'll get some of my earnings, call it down the road, because I didn't have the capital to put into the deal. This is how I had to do it. And so now I still got a gap. I got $3.6 million. I need $4 million. And so I got $400,000 gap. The bank may say, well, Adam, I'd like to see you do a 10% down payment, a 15% down payment, a 20% down payment. And I'm thinking to myself, I don't have that money, right? So first I'll tell you, not all SBA lenders have the same requirements. They operate under the same government program, but you walk into Wells Fargo and they're going to say, I don't care how much you got rollover. I'd say, I want 25% down, period. End story. I may go to another lender says, you got 15% from them. You give me 5% cash. And I'll let you go, or just give me a check, Adam. I don't care. Just give me something. Give me $50,000. I got to see you bleed a little, and sign a guarantee, and I'll finance that deal. So although they're lending under the same program, there are literally thousands of lenders who participate in the SBA program. I can download a list of them off of the SBA website. Once I go on there to register, and so I got to call around because they're all created equal. But I could also do something else, which one of my clients does all the time, and that is, hey seller, you're going to loan me that $400,000 on a side note, so it's going to be seller financing, and I'm going to put it on full standby for 2 years, which means I don't have to make any payments, and then it's going to accrue interest, and somewhere down the road, I'm going to start servicing it. I got to pay it off within a certain time window. So you're going to get money up front, nice chunk, and then a few years down the road, you start getting interest payments from me. And eventually when I sell a business, I'll pay off the note, or I'll use the earnings to pay off the note. SBA looks at that two years of standby and says, this is as good as equity. And so I now have filled my gap. I got $400,000 seller financing. I got $600,000 seller rollover. I borrowed $3 million from the bank, and I haven't put a dime in. And I do see deals that are no equity happen. Some of my clients do these deals, I've got other clients, who write a small check, or they go get friends and family money. If you're working with someone, it's your first deal, and they're saying, dude, I need to see 10% down cash. This is $4 million. You need 400 grand. Well, now I'm on the friends and family plan. I'm looking for friends. I'm looking for relatives, mom and dad, somebody. It's like, who wants to throw in with me in this adventure? And, I'm going to Ryan. I'm like, Ryan, I need to raise capital. And maybe I go to a family office, and the family office, I go to a mezzanine lender, someone who charges high interest rate because they're willing to subordinate to the banks. Banks will have first tier. They'll come in second. Banks charging 10%. These guys charge 14%. It's expensive money, but they're not secured. The banks are secured in front of them. So there's so many different ways. I think for most entrepreneurs, they think money is their problem. But what it is they haven't done this before. And so it's an unknown area. And so for them, it seems to be the big mystery. I'm a guy who does this all the time. There's plenty of money out there in the world. We just have to know where it is, and we have to know how to treat it. We want to treat money well. If we don't have money, we pay, if someone wants 10% and it's a private lender, it's a person, it's someone who's making a speculative loan to me, hey, maybe I give them a couple points extra. Maybe I give them some equity on top of that. If it's a mezzanine lender, they want some warrants, or they want some, it almost works like an option. They want a piece of the upside that you're going to create using their money. And so I just go to them, I give them more than they ask for. And I make it sweet so that it's easy for them to tell me yes and tell someone else no. Because when we're both, if I got two parties who are paying the same costs, well, then the lender's focused on who's the better risk. And if I've never done this before, I need to change the dynamic. And so maybe I tell that private lender, I'll pay you more and I'll give you some equity and I'm sweetening the deal. Well, why are you doing that? Because you're helping me achieve my goals and objectives. And I know that you could lend that money to multiple parties, and I want you to take that risk with me. And so I'm going to do my best to take care of you. I'll never forget when I was in the Army, and I bought my first new car. And I remember the lender because I couldn't get bank financing. So I'm like kind of one of these loan houses, And I remember that this lady, and she's like, Coffey, don't make me come looking for you, Coffey. You better make that payment, And it's like, know where money is, know how to treat it well, and you'll get yes. I'm on the board of a company right now, Ryan, where a couple guys who were not senior partners in the world of finance, they were more junior guys, analysts, PE, investment banking. They got some background, they got some, education. But I watched them walk into a family office and walk out with $100 million in financing, to do roll-ups, and they threw me on the board of it, to help them and help them mitigate risk. Someone who's been there, done it a number of times, makes money feel comfortable that there's an old guy around who's a veteran of doing this. And so there's so many different ways to get the money, but I try to buy the right company. And you know what? I'm just going to flat out tell you, if you're buying a software company that trades at 10 times and has no real cash earnings, I'm sorry, but you're going to need equity. I don't have a fix for the math doesn't work. That's why I'm focused on certain industries that have low capital expenditure, high free cash flow conversion, and trade for low multiples. Because these unsexy businesses that trade at low multiples, that's where I can make a killing. And that's where I can use the money in the business to pay for the loans to buy the business. And that's where I have a higher probability of getting no money down type deals done. And so, I know you're an expert at this, but for a new guy starting out or a new lady who's buying their first company, and they're gonna step into it. I know this is a real scary area, and a lot of people freak out over personal guarantees. Well, if you don't got any money, and you don't have, if you're a big hat, no cattle, then risk and reward go hand in hand. It's like if you're not willing to take the risk that you're going to lose what you don't have to get somebody else's money, I can't help that mentality. You need to be willing to assume some level of risk when you're buying a business and you're asking somebody else to fund it for you. And so with the risk goes the reward.
Brilliant. Yeah. And you brought up a good point. So I run fundraisecapital.co, and in there, fundraisecapital.co, actually a guy just joined. He raised $4.5 million. First raise, $4.5 million in 45 days. The guy's a man. That's obviously a shameless plug, but however you do it, it's really important in raising capital, understanding who to talk to, because Adam, I believe, I've coached over 2,000 people to launch their own funds, and many of them are private equity. But the one thing, no matter what your asset class is, the one thing that would make all deals fall apart was this phase that we're talking about. They could not raise capital beyond friends and family. So what Adam's talking about is this debt financing where you can get, have them roll over 15 or so % of their company, do that, take a course, pitch a family office, get partners. There's many ways to do it, but you got to do it. And so understanding how to raise capital, I think, is one of the most important things, because you could know everything about private equity, but if you can't get the money, all of that bright intelligence and spirit and passion, you're going to find yourself in a little bit of trouble, and you're just going to be this perpetual big hat, no cattle guy. Would you agree?
I do. And again, it's scary if you've never done it, but there's so many people out there who have done it that you can get, again, coaching, guidance, mentorship, and you can find ways to get this done. 15, 20 years ago, I remember I helped my brother we bought an insurance agency that we paid $4 million for. And we literally got the seller to do $1 million note, 10% interest. And we went to a family office, brought in a family office, got $2 million worth of financing from them at 10% back in the day. And the cash flow within the business serviced that $3 million in debt at 10%, no problem. We had about $1.7 million in free cash flow. We had $3 million in debt, and then we made $1 million equity. And so $1 million was equity, because we could afford the $1 million. If we couldn't have afforded the $1 million, we could have made equity $10. And we could have borrowed more money. In the family office, we also gave ownership to. So they not only got the interest and got their money back that they loaned us, but then when we sold the business, 15 years later, after we had been distributing, $1 million, $2 million a year for like 15 years, we then sold it for $12 million. And they got another chunk of money based on that. And so they clipped the coupon on the 10%. Then every time we did a distribution, they took money off the table. And then at the end, they got another bite. When you add up all the paydays over a 15-year period, that family office was thrilled with the returns that they saw on this little insurance agency that my brother and I bought for $4 million. And for my brother, it was his way of earning a living for, the majority of, the later years of his career for 15 years. He's still there running it today. We sold it to Acrisure, a big insurance, corporation, buys 100, agencies a year. And he got the rollover, second bite of the apple. They go public next year. He gets another bite. I was passive, so they didn't let me roll over. I had to walk out the door with my parting gifts. But it accomplished everything that we wanted to accomplish. And we didn't actually use a bank loan for any of it. And we were debt free within about 4 years. We had paid off the debt. And then it was just distribute money like an ATM machine for the next 10, 11 years after that until we sold it. So, as you said, people can come to you. They can take your course in how to raise money is a great example. But this is something we need to do and think about before we ever even start looking. This is a part of the program. Where will the capital come from? Based on my research and thesis on the industry before I ever started, way back when, first episode in the beginning, when I was laying all this out, I should have been able to build a model and say, here's what I should have to pay according to my research. These are what these companies sell for. And this is kind of how I'm thinking about putting my capital structure together. So I'm doing one right now in bookkeeping accounting, and I'm gonna use about 1.5 million of capital, which for me is a very small amount of capital. But my returns, to build a business in like a 3-year period and buy 4 or 5 and put them together and just kind of move it on down the road, I'm looking at like 20 some odd million in return on a $1.2 million, equity investment. The rest of it is borrowed money, it's rollover capital, it's seller financing. I service all of that, put this together, walk out. It's like use 1.2 million, walk out with 21. That's good math. If I didn't have the 1.2, well, I wouldn't walk out with 21. Maybe I walk out with 15 because I'm going to have to give, some of that return to get the rest of the capital that I need. I'm going to have to bring on a partner. But so many ways to engineer this and pull this off that money should not be the reason you fail to pursue, this kind of an entrepreneurial dream. You'll never become wealthy as a W-2 employee working for somebody else. right now as baby boomers are retiring. We've got the greatest wealth transfer in human history. And it's your time. It's your time to get out there and do this. Based on everything we've been talking about, across these 2 episodes, we kind of laid out the framework on how to do this. Obviously we can't cover everything in detail in a couple hours, in 2 podcasts, but there's books out there. You've got a course on raising capital. I've got books like Empire Builder to teach people how to do this, this process. And you can do this. That's the point. People doing it every day. Why not you? It's kind of get off your duff, get out there and live the dream rather than just thinking about it for the next 20 years.
Mm-hmm. Yeah, you're spot on, man. And that's the mission of the show. Like I said, twofold mission, which is to redefine the value of the human spirit. And the second one is to activate the rise of the rest, meaning there are a lot of people with just a little nudge from Adam and I, and you're going to be well on your way. Now, you mentioned before when you did that insurance deal that your brother was active and you were passive. So that implies there's a phase that after you get the money, you close the deal, everything's signed. Now you got to run this company and run it to Profit Town all the way to the finish line. Talk about a little bit about being active and being passive now that you're at this phase of running the company.
Well, whether I'm active in it or passive and providing governance and guidance to it, once I'm in it and I own it, I'm responsible for it. I'm seeking to generate alpha. I'm looking for my return. And so, I have a playbook, that I actually lay out in the Private Equity Playbook. It's like I want to accelerate the growth of earnings. I want to get this company growing. It's one thing to buy a bunch of companies and put them together, and you do get multiple expansion. Bigger companies sell for higher multiples than smaller companies. I can collect a bunch of companies, pay small multiples, and by putting them together, create something bigger that will trade for a higher multiple. But a PE buyer, or any buyer doesn't want to see a collection of companies. They want to see an integrated empire. And they also want to see consistent growth organically, improvement in margins. As we're getting bigger, we should be getting more efficient. So our profit margin should be accelerating. Our margins at the gross profit level should be increasing. It's like, more clay on the wheel. We've got more to work with. If I was buying pest control companies and I had, 5 trucks on the road and I bought 1 new truck, I don't get the same price as if I have 500 trucks on the road and I got to buy 50 this year. I'm going to get better pricing. So my pricing, my ability to hit my suppliers for more effective pricing, my ability to be more efficient as I'm getting bigger, I've got to be able to demonstrate that. So I always tell people, I'm doing a mini roll up and I'm buying essentially $4 million in EBITDA, because that's my exit point. I also want to get to 5-6 million, and I want to do that organically. And so we have to be really focused on growth. What is our growth story? We have to have a good story to tell, so that when a buyer walks in to buy it from us, it's like they know where this business is headed. There's a trajectory that we've established. Yes, we bought multiple companies, put them together, but now look at our organic growth rates. Look at how fast we're growing organically. Look at our margin improvement, that we're getting and we're seeking, and with your capital in the next phase, I can really accelerate my growth plans. I'm bootstrapping, I'm doing the best I can. I'm doing everything, in my own little wheelhouse, but with your capital and, your assistance coupled with the leadership team in this business, we can now really rocket ship to a different place. So we have to be cognizant of the story. Oftentimes when I walk into a business, I immediately start attacking. I have a standard playbook: price, volume, pivot, and tiering products and services. So price. I've never found a company yet that has price optimized. Matter of fact, most companies tend to look at what's my cost of my product or service and what's the margin I want to make, and I add that on top, and that's how I price. And that does not take into account what a consumer is willing to pay. And so I have to find additional price. In the last 3.5 years, that we've been living through this inflationary period of our economy, cumulative price increases have totaled around 30%. Everything we do today is 30% more than it was 3.5 years ago. I bet you there's not many companies out there that have raised their prices 30+%. And so right now we have this great period of air cover where everything we buy is more expensive, and we should have an ability to pass these costs on to customers, and consumers. I get emails every day. Hey, Netflix, we're raising our price on January 1st. It's like, and hey, Apple's raising the price of this, and Adobe's raising the price of that, and QuickBooks is going to jack up my rate. January 1st, like everything's getting more expensive. Great time for you to also be raising prices. I do a lot of work around optimizing price, and every penny I can get in price immediately falls to profit. So price is important. Volume. What is the strategy for sales and marketing in this company? A lot of small companies really don't have a good cohesive strategy. And so I'm always focused on, how do I sell more stuff? How do I sell more stuff at a higher price? And then, so price, volume, pivot. Hardest thing for us to do is get a customer. Once I get that customer, what are the strategic pivots I can make to now sell that same customer additional products and services? I've got a landscape maintenance company. I signed a contract with you. It's recurrent, and it's to blow and go. It's to mow, blow, go. I'm cutting your grass, every week, and then I'm blowing off the sidewalks, right? Well, now I come back to you and say, hey, you know what? I also do bed mulching. Can I remulch your beds? And hey, while I'm here, I can also plant flowers twice a year to help your yard look beautiful. Hey, by the way, I also can do pest control on your lawn to keep your lawn, and I can do fertilizer on your lawn. And hey, I do exterior landscape lighting. And hey, it's the holiday season. You want lights on your house? Boy, I can hook you up with lights on the house. And I've got all these different products and services that I'm going back to my core customer base, constantly hitting them with new things that I can do for them. Maybe a different person in a different truck. These are the strategic pivots, and then I tier my products and services. Good, better, best. Never give one quote to a customer when I can give three. Why give three? I don't know, because marketing research says 3 is the right number. 60% of consumers will buy whatever the middle product is. I don't need the best. I don't need the worst. So whenever your one product was, put it in the middle. Now find extra things that you can add to it, because some subset of your customer base is willing to spend more. They're willing to buy the best. And then I can also create a de-featured product, which will let more customers say yes to my proposals that I'm putting out the door that I otherwise wouldn't grab. And so by raising price, by increasing volume, sales, marketing, by creating strategic pivots, by offering good, better, best type packaging of services or multiple services, with features, what I'm doing is I'm learning how to accelerate the growth of this business that I just bought. And then I hit the cost side, my levers for cost, margin improvement, high value work, low value work. Every person, I don't care if you're a janitor, a planner, or a president, everybody does some things that add value and some things that need to get done, but they don't add value. If I'm a technician and I've got a skill to fix, your TV in your house, high value work is me being in your house fixing your TV. Low value work is driving, it's filling out paperwork, it's ordering parts. And so when I think about all my employees and I think about high value work, low value work, I look at the low value stuff and I say, can I eliminate it? Can I outsource it? Or can I find an investment in technology that will automate it or make it more efficient? And so I'm constantly attacking, optimizing my service delivery, product, service, whatever kind of company it is. And so I'm also focused on margin, because when my goal is to grow earnings, which is what I'm selling a multiple of, all of these levers come into play. I've got price, volume, pivot that pushes up the top line. And then I've got margin improvement to lower my cost, and everything is now additive to my earnings. So we need a growth story. We need to focus on running a better business, on, if we're buying multiple companies, on integrating those companies to maximize the potential. Now I got to memorialize that with a story, with a multi-year plan, and at some point down the road, 3 years, 5 years, whatever that time period is, I'm ready to take it out to market. I'm ready to sell it. I'm ready to reap the rewards of what we've been talking about for the last 2 episodes.
Brilliant. So now once you sell it and you're ready to, like you said, take it to market, and once you're ready to do all of those things, now it's time to scale up. You mentioned earlier in this conversation, it helps you to bulk up. And so you're adding these portfolio companies, or portcos as we like to call them, as well as planning for your exit. So especially if you have investors, there is that hard expectation usually that you're going to create an exit, or sometimes we use a fancy word called liquidity event. So we'll have a liquidity event and sound smart and make our mother proud and use big words. But either way, we got to create that liquidity event. And investors like it, and it puts a little bit of cash in your jeans. So now here we are, we're building our portfolio. Talk about what is that. Now we're at the rinse and repeats phase. Talk about what is required to build your portco and then plan for your exit.
Yep. So let's just talk about, I start with the end in mind. So I'm a pilot. I don't take off unless I know where I'm going, and I deconstruct the trip. So when I'm building, if I'm buying small companies, I've got two logical exit points that I can hit in a relatively short period of time or efficient period of time. I can get to about 4 million to 7 million of EBITDA. That's kind of my first window where real legit PE firms that have funds with limited partners and real investors and capability, I can find some really good firms in that size range. And so if I hit 4 to 7 million in the kinds of companies we're talking about, I might have been buying them at 4 or 5 times, and I'm going to sell them at 8 times. So I buy 4 million, I grow organically, I get to 5, 5.5, 6, I sell it for 8 times, I got $48 million. If I bought 4 million of it at 5 times, it cost me 20, I'm selling it for 48. Yeah, there's a $28 million delta in there, and that's going to me, it's going to all my investors, everybody that was around the table, the former owners of the companies I bought, if they rolled over, and so I can go there. I can go push a little bit farther. Maybe I buy the first company, it's got 2.5, 3 million in earnings. And then I'm bolting on smaller companies on top, and I'm going for, I'll call it 10, as the start of the next window where I get really good buyers, and so 10 is about 17, different class of buyers, now that company that was selling for 8 times down in the lower 4 to 7 range, now maybe it's selling for 12 times 10 equals $120 million potential exit. And literally, if I bought all 10 million of EBITDA, just for illustrative purposes, and I paid 5 times for each, that's 50 million, but I just sold it for 120, and so I made 70 million profit for me and my owners. I'm going to have to buy more companies to get up to that size. It's going to take a little bit longer, but the returns are bigger. So I'm designing to build from scratch at either 4 to 7 million of EBITDA or kind of 10 to 17 million of EBITDA. From there, next real great exit point kind of gets way up in the stratosphere. You're talking about 40 million in EBITDA. And so I don't plan for that one. I'm going to have a partner, because I never want to see an entrepreneur have more than 100 million in equity in their company that they haven't tapped and cashed out and gotten some asset diversification. But I think you can hit singles all day long, and do these mini roll-ups where you're going, I'm going to buy 4 million, and then organically I'm going to get it to 5, 6, and then exit. And it's going to take me probably 3 years, 4 years tops to do that. And I'm going to take these singles. Maybe I do multiple of these simultaneously, multiple industries. I'm a home services guy. I focus on a couple different verticals, and I get these things going. I'm the passive guy. I've got someone running my business. They're going to share in the wealth creation event with me. I'm arranging the capital, doing the hunting, doing the outreach. I'm focused on the finding and acquiring. They're focused on running the business, and we're a team. And I could do a few of these and get these things going. And I'm working with a family office now who our goal and objective is we're going to get 4 of these going because they want to create about $100 million in profit in a relatively short period of time. Rather than just build one, we're going to build 3 and get them going, 3 or 4. And then take them as far as they want to go. Maybe we do a couple of them at 4 or 5 million. Then we do one up to 10. It's like, multiple exits planned for, and the family office is seeking to do this and get 3, 4 companies going at a time. When they start exiting, it's boom, 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 multiple liquidity events that are going on. And now they're kind of, stocking up, the family office treasure chest with, the goal was, want to make 100 million in 5 years. Like, great. This is how I would arrange to do that.
Perfect. So as we wrap things up, any closing remarks or anything else you'd like our fans around the world to know?
So I would just tell you, that you and I are kind of, I don't know, seasoned disciples of the game. And, we've spent a couple hours now talking about how to do this stuff. Obviously, we can't fill in all the blanks. There's a lot of learning that has to be had from there. So take this as a primer, something to stimulate your creativity, your thinking. And you're listening to us. That means you're interested in doing this stuff. Let's plan to get you off of the sidelines and actually get into the game and start doing this. And so we can read books, we can listen to podcasts like this, we can get coaching or mentoring, we can take courses like yours on how to raise capital, we can read books like mine. It's like, let's start building this ecosystem and let's focus on getting you into this game. And instead of being a dreamer, let's make you a doer, as we head into close out this year and head into 2025, let's get you in the game and make you a person that's doing, not dreaming.
I love that. So just to round everything out and just to summarize everything we talked about, get your heading. Make sure you know where you're going before you even begin. Tell your story with numbers. Build your plan to buy a company with little to no money down. Build that hit list of companies and make sure you understand who it is you're talking to. And heck, even do that with investors. Then contact those sellers, build the relationships, and above all, don't do anything to freak them out. Get the money so you can do this. And there's many ways to do it. Either you know people or you need to learn, like a place like I teach at fundraisecapital.co, or read Adam's books. And finally, plan your exit as a function of EBITDA. You do these things and you too will be well on your way in your pursuit of making billions.